Okay, so I'm going to start again. My name is Michael Olafusi, and I'm going to take you in this month's webinar through using Excel for financial calculations. If you have read through some of the uh, descriptions I put below the video and in the invitation you got, so I'm saying, what if you want to do some savings plan? So you see, I have here. Let me make sure you can see my screen clearly. So you can see I have here, number one demonstration is using Excel to create a savings goal, right? The number two is using Excel for loan calculation, and then number three is creating a loan schedule with Excel. Okay, thank you all for the confirmation, loud and clear. Okay, great, thank you. And number four is you want to take a mortgage or you want to take a car loan. How can you flexibly plan towards it, and what are the things in Excel that can help you with the planning? Then also, if you have a monthly savings plan, how can you decide how much it will come to in some number of years? Also, if you are trying to set up a business, how can you check out what makes sense, what does not make sense, and not just doing it in your head, doing it knowing the actual figures, the numbers. So it's not like you thinking the idea in your head and you are thinking today it will work, tomorrow it will not work. But once you can lay it out in Naira and Kobo and you work with Excel, some formulas I will show you, you will have that peace of mind. It's going to work, and if it's not going to work, you know that there's no road there. So unlike the emotional analysis most of us do. And then I'm going to now take us through tools I use for stock analysis and some other things that you'll find useful. So let's start. Number one is this savings goal. So let's say you want to save 20 million naira for an education fund towards your child's maybe university schooling, right? So how can you know how much to contribute, say monthly or yearly, if you put the money in an interest bearing account? Okay, can I share the sample of the file? Yes, I will. So I will share this very file with the formulas and everything in the share it with us after the webinar. So thank you for that question. All right, so you have a goal to save towards an amount. It could be for a house, for your child's education, or even for a car. Though I don't advise people should save towards a car. You should save for something a lot more meaningful. So how do you now know how much to save yearly or monthly, right? So the formula we're going to be using is the formula number one you have to be very familiar with in using Excel for financial calculations. PMT. That's the name of the formula. So I'm going to wipe out what I've done in here, and then we're going to do the calculations together. So let's start first with, this is the goal, right? You want to save 20 million naira, and then you are putting it in an interest bearing account, an investment account, maybe a fixed deposit, I don't know, whatever kind of account. And then this is the rate they are giving it to you at, the interest they are going to put on your money for you. So this is the interest rate they are giving you. And so 2030 is in 13 years time, right? So you're going to be saving for a period of 13 years. So in 13 years, you want to have exactly 20 million naira in that special purpose account. So how do you know how much to save yearly? And that brings us to that formula PMT. And as you know, in Excel, you do equal to type the formula name. And to make it easy for you to follow along, I'm going to use the interactive formula box. So I'm going to click on insert function, and then this will come up, right? So it makes it a lot easier to explain how the formula works. So let's first of all check out this description. PMT is a formula for calculating the payment for a loan based on constant payments and interest rates. But then it also works for savings goals, so it's not just for loans, right? So like in this case, we're going to use it for a savings goal. Then in another case, I'll use it for a loan. So here is how it works. Number one thing is the rate. So what is the rate at which the investment account, the bank, whatsoever it is you are putting your money in, what is the rate of return interest rate they will put on your money for you, right? So now let's start with the yearly contribution calculation. So this rate is an annual rate, right? So I'm going to pick the rate here now, right? And then for how many number of periods, in this case we are talking about duration in years. So because I'm doing the yearly contribution calculation, and then I'm going to be saying for 13 years, so you will keep saving your money in there for 13 years, and then it's going to ask you how much have you saved currently. So what's the present value? So how much is it already you have? PV stands for present value, in case you are not an accounting background person, or you are not familiar with some of these terms. So PV stands for present value. So what you have saved, what you have, what's the present value of what you have, what you have right now. And then because you haven't saved anything, you are starting, so we're going to put 0 there. There is no money you have saved for now. So what is the future goal? How much do you want to have at the end of the period? And that is what our goal is, right? So we want to have 20 million naira at the end of the whole period. So I'm going to pick it, but something will happen which I will show us how to correct it. So I'll pick this as the future goal, and then you have type. So type is a very straightforward question. Do you save this money at the beginning of the year or at the end of the year? So let's say you save this money at the end of the period. So if it's a year, you save it at the end of the year. If it's a month, it's at the end of the month you make the contribution. So if that is the situation, you just put 0 or you leave it blank. So I'm going to leave it blank, which is meaning, we put the money in at the end of the year when you collect your salary, or at the end of the month, in this case at the end of the year. But if you want to save at the beginning of the year, then you're going to put 1 there. So I'm going to leave that at 0 or empty, like omitted, which is equivalent of 0, and then do OK. So now you see it's giving me the answer, but then you can see there's a minus beside it. So that's what I meant when I said something is going to go wrong, but I'll show us how to correct it. So that's one thing with this formula. It's the logic behind it makes it such that once you type in all these figures, you end up getting the PMT come out is 0. So one classic way we fix that is we say minus for that future value or for present value, whichever one you want to put a minus in front of. So I'm going to put minus in front of the future value, and that will fix that one. All right, so that's not a big deal. The main thing is it gives you the yearly contribution you need to make. So how about you want to make monthly contribution? How do you figure out how much to save monthly towards that goal? Okay, so for that we are going to use the same formula, PMT. So that's why I say this formula is I would say it's the number one formula if you want to use Excel for your personal finance and some of your investment calculation. Get very familiar with this formula. Okay, so how about for the monthly one? And it's a little more interesting. So again, equal to PMT, I open bracket and I launch the interactive formula dialog box. So once again the rate, but now that we are doing monthly contribution, I have to make the rate agree with the period. When we did for yearly, rate was yearly, duration was yearly, but now that we're doing for monthly, right, then I have to break the rate into monthly rates, right? So that will be this rate, which is the annual rate, divided by 12, because we have 12 months in a year. And then for period, again, it's going to be 13 years, but then times 12 months. So because we have 12 months in a year. And as usual, you've not saved anything yet, so present value 0. And what is the final amount you want to have at the end of the whole period? The future value. So I'm going to put remember I'm putting minus so that I don't end up with that negative figure. So minus and then that figure, and I'm going to leave this as omitted, as blank, so that we are telling it we save at the end of the month, right? And then I'll do OK, and instantly you see it tells me that if I save 42,057 naira every month, in 13 years time I will end up with 20 million naira. Now let's see the importance of this interest rate. Assuming there was no interest rate, so let's see what will happen. If there was no interest rate, right, you're going to have just this amount times the 13 years times the 12 months in a year, right? So I do enter, and that tells us that the actual amount that you've saved is 6 million, but because of the interest rate, it's turned it to 20 million. So that's why I say you will want to get familiar with these for your own personal finance, right, and planning, because when you put money in the bank, especially when you put in an interest yielding account, then you want to factor in the effect of interest rate. So you're not just going to start multiplying the money, I'm saving 40,000 naira, 12 times a year, and then, so you want to do that, right? So that is it for the savings goal. I'm going to continue. Sorry for the loud background, the noise coming up. I think someone is trying to fix his car, 2 houses away from here. All right, so moving on. If you have any question, just drop it in the chat box. So I move on to the second one. So the second one is, in fact, I'm using a real life calculation. If you know my dad, please don't tell him about this. So early this year, my dad decided to take a loan of 400,000 naira from Lapo Microfinance Bank. So it's those kind of loan that you need to do something like an emergency, and you just need like a tipping weight kind of amount of money, and somehow he didn't want to get it from someone, he just wants it from someone that doesn't know him. So that's why he decided to go to the microfinance bank, and he has a kind of relationship with them, and so they gave it to him. But then I was aware of all the conditions, so they gave it to him and said he was going to pay back equal amount, the same kind of amount every month for the next 6 months. So it's a 6-month duration loan, and then the total money he's paying back is 479,000, but then split into equal monthly payments. So now the question is, how do you know the rate at which the loan was given to you at? So they didn't tell him this is the rate. All they gave him was, okay, these are the conditions, 400,000, then you have to pay back this amount of money every month, and then for the next 6 months, and don't default, give us your guarantor. And so, but if you're going to be planning, if you want to be very detailed with your plans and decisions you make, you will want to calculate the rate at which they're giving you the loan at. Well, for me, if I was the one taking that kind of a loan, I want to know the rate. So maybe, I don't know, maybe if it's worth it or not. Maybe you wanted to use it for a business, but the business you're using it for going to be able to generate enough to cover the loan, in terms of rate wise. So let's see how you do that calculation in Excel. So again, this is the loan you want to take, 400,000. Well, in this case, the loan my dad took, 400,000, and then this was the amount it was broken down into, right? So 6 equal payment amounts. So that makes it comes to 479, but this is what you'll be paying back monthly. I'm using this example because whenever you take loans from most of these microfinance banks, this is the same method they use. Some might even charge you some admin expenses separately, but the main repayment, the main loan you are repaying, they split it into monthly repayment plans. So if you want to find out the rate they're giving it to you at, then you'll have to do what I'm going to show you. So let's start. You'll be paying back this amount every month, and you'll be paying this for the next 6 months, right? So how do you calculate the rate, the monthly rate? So let's start with the monthly rate. So the rate at which, monthly one, the loan they're giving it to you at. So let's see that. The formula we're going to now use this time is called rates. And then this is how it works. Sorry. So in here, I'm going to say equal to rates. And then let's use the interactive formula dialog box. So number of periods. So it's a 6-month loan. So 6 months, the number of period is 6. How much will you be paying, every month, every period? You'll be paying back 79,000 every period. And so what is the present value of the loan? So how much was it that you requested? How much did they give to you? And then that is this. But remember what I said about you need to put a minus if you don't want to get the answer in a negative, right? So I'm going to put a minus before picking that. And then what's the future value? So again, in this case, you have to pay back everything. So future value is going to be 0 at the end of the whole scheme. You will not be owing them, they will not be owing you, so 0 future value. And then you'll be paying back at the end of the month. So in this case, again, I'll be leaving the type blank, and that is it. And you do okay, and you see instantly it gets you the rate. So it says the monthly rate is 5%. But then again, we are used to annualized rates. Most times all investments are best put in an annual rate, because most of the other important figures in business are annual rates, right? If you're doing a business, you want to know how well your business is growing. Most times you say how did it grow year on year. And then when you want to buy, say, T-bills, or you want to invest in some investment schemes, uh, proper ones anyway, they usually give you the annual rate. So in this case too, I'm going to want to annualize it, right? So now in the annual, to do the annual rate, I'll use a very simple one, because you can this is can be very controversial in terms of, do you want to compound it, or do you just want to do an uncompounded annual rate? But here what I think is fair is just to simply use the uncompounded one, which is simply to just say, the monthly rate times 12, and then you can now take that as that is the annual rate at which the loan is being given to you. So that's one way of maybe analyzing it, because in this case we are doing a monthly repayment, and so the rate we are going to get is a monthly rate, and then you can easily analyze it by multiplying it by 12. So that is it for loan rate calculation. If you have any question, I'm monitoring the chat box. Just let me know, and if at any time you dropped out of the conversation, I mean, if at any time you cannot hear me anymore, or things are going blurry, do let me know. So if any issues. Okay, so continuing, I'm going to go to how you do a loan schedule. So you take a loan, maybe for business, for personal use, and then you want to draw a proper loan schedule, like a repayment plan. So how in Excel can you build that up? So let's see the example I've brought up in here. So you took a loan of 100 million naira at annual rate of, so let me increase the zoom. So you took a loan of 100 million naira at an annual rate of 25% from a bank, and you'll be repaying both interest and principal over the next 10 years. So the question is this: if you are going to be paying back equal amounts to cover interest and principal, which is similar to this one I just finished, because my dad was paying back the same 79,833 naira every month. So that means he's covering both the principal and the interest, but paying back exactly the same amount. So for that, this is the situation he's working with then, because he's paying back an equal amount every period to cover both interest and principal. So how do you build out the loan schedule? The question is, build out a loan schedule for that. And in this case, let's ignore admin charges, because usually banks will charge you some things like admin charges, things that you pay for outside of even the very loan you are taking. So let's just ignore that one, and then let's build up the loan schedule, right? So how are we going to build that up? I'm going to have to delete everything in here so we can build it together. So I'm going to delete what I have in here. So remember I said you borrowed 100 million naira at 25% annual rate, and then for the next 10 years. So meaning you'll be paying back every year from year 1 to year 10, right? So that is the year period portion of the loan schedule. And then we want to calculate how much you are paying to cover interest, how much you are paying to cover the principal part of the money, and then how much you are paying to, you're paying every year. So let's start with the one that will help us calculate the interest portion of your loan, and that formula is called high PMT. So high PMT, click on the formula dialog box. So we have this interactive formula dialog box. So what is the rate you've been given a loan at? So you've been given the loan at rate of 25%. Okay, so 25%. And then what period are we calculating for? We're calculating for the period number 1, the first year, right? So I'm going to put 1 there. And then the whole loan is going to be for how many number of periods? So it's going to be for 10 years, right? So what is the actual money you borrowed? So you borrowed the present value, you borrowed 100 million naira. And then remember what I said about you put a minus and then you pick the loan amount. Then again, there's no future value. You're going to pay back everything. So it's not like you're going to, at the end of the 10 years, still hold them money or they owe you. So you're going to net off everything, right? So that is it for this. So you can see that's how you fill that in. The only extra thing that this makes this different from the PMT we just did is this one asks you for the specific period you're calculating for. So like now I'm calculating for year 1. That's why I had to put 1 here, right? So when I'm doing for year 2, I'll put 2 there, right? And so that is it. And then I'll do also for principal. Principal is PPMT. And again, the rate at which you've been given the loan. What period are we calculating for? So we are calculating for period number 1. And then what is the number of periods? So this is the number of periods, like 10 years. And then what is the present value of the loan? So this is the present value of the loan. Again, you're going to repay back everything, right? So nothing in that portion. And then we do the one for the actual money you are paying, which is PMT. So for the actual money you are paying, again I will click on that formula dialog box okay, so I click on the formula dialog box, and what is the rate again? This is the rate. The number of periods, this is the number of periods. And okay, so number of periods, what did you borrow? So you borrowed this amount, and again, you're going to pay back everything. You pay back at the end of the period. Okay, so are you okay for that? Right, so if you notice something, interest plus principal is going to equal what you pay back, right? So look at it, interest plus principal. If you look at what it's giving me in here, you can see it's equal to 28,000,07256, which exactly is what I have in here, right? So I'm going to just drag them down. Because I want to drag down, I'm going to just lock some cells, and then I'm going to drag down, and just to make my life easy, I'm going to replace the 1 and 2, the one in those places, with something that I can drag down, and I'm going to get what I expect, right? So I'm going to drag these down, and that gets me for the other periods, right? So if you notice, for year 2 it's 2, right? You can delete everything and put 2 there, and you see that's year 2. But this formula I done here make it easy for me to be able to drag down. So that's for a different day. Just it will be very boring if I spend the whole time doing the formula one by one, and that's why I had to just do that trick to make it faster. But in your own case, if it's too much of a hassle for you, you can do it one after the other, and you still get the same answer. You put in 1, you put in 2 for year 2, 3 for year 3. So, and then you want to know how much you've paid in total. So in the first year you paid this amount. In the second year you will have paid what you paid in the first year plus what you are going to pay in the second year, right? And if I keep adding all of those figures up, it gives me that this is the total amount by the end of the 10th year you will have made the total amount you'll have paid back to cover the loan principal and interest. So actually you've paid more than twice, almost twice the loan value, but that's the work of interest rate. So when the interest rate is really high, you end up paying a lot more. Okay, so that is it for this example, and you see we use three formulas here: PMT to calculate payment, IPPMT, so high PPMT to calculate the interest portion, and then PPPMT to calculate the principal portion. So any questions so far? What if I want to compound my annualized rates? If you want to compound the annualized rates, which one is that? That would be okay for the example I had shown in here. Okay, if I have time I will come back to that because it's not a very straightforward answer. Okay, someone saying the picture is not clear again. Is that a general thing? Actually, you should, if the picture is not, if the screen is looking blur, you might need to set the, let me show you how to do that. So if it's coming blur, right, you might need to come into settings and then set your quality, set it to 270 or 480, whichever one your internet can support. So that way, leave it from auto. Auto keeps downgrading it based on your internet speed. But once you set it to quality of 720 pixel or 480, you won't have any issue. So let's continue, and then continuing the same loan issue. So the same, you borrowed 100 million naira, 25% annual rate, you pay back over a period of 10 years, but this time you are not going to, we're not going to be using the equal amount constant payment one. You're going to be using the fixed principal. Fixed principal means they split the principal over the years of the loan. So you can see here, let me do the calculation for that for you. So this is another kind of way banks calculate loans they give you. So if this is the method they are using for you, which means they take the principal, okay, so we take the principal amount and then we divide it by the duration of the loan, right? And that brings us to how much you need to repay to cover the principal, every year. So now you see this is the principal portion of the loan, comes to 100 million naira, right? Which is what you took. And then they need to calculate the interest. So let's see how you calculate the interest. So to calculate the interest, it's this way: the interest on the outstanding amount. So interest on the outstanding amount, right? And that is very easy, is equal to outstanding amount, which is summation of all of these, but because I'm planning to drag it down, I'm going to do something about it, but that's just it, times the rates. So times the rates, and that is what I'm going to drag down, and that calculates for us the interest on the loan. Okay, I've done something wrong somewhere. Okay, I forgot to lock this one, make absolute. Maybe in another video I'm going to show us what we call relative and absolute referencing, right? So but don't worry about that for now. You just type out the formulas one after the other and you will always get the answer, right? So now interest is, again, let me do the interest portion again for you to see, is equal to the summation of all what you owe, right, times the 25% rate. If I'm going to do for year 2 is also going to be summation of all what you owe. So in year 2 you will find out that what you owe is simply, since you've already paid the principal, you've paid one portion of the principal in the year 1, you will not be paying interest on that one. It's only on the outstanding amount. So it's going to be on just this money, right, from year 2 downwards, times the rate, right? And that's what I kept doing for the other years. So now the total payment you are making is going to be this plus this, right? And I'm dragging that down. So the thing about this is you end up paying a lot more at the beginning of the loan. Some banks prefer this. That way they will have recouped the most. In case if you default, they get to recoup a larger chunk of their money, earlier on. So that's one advantage of this one for the banks, right? So again, cumulative amount is, in the first year you pay exactly that. In the second year you pay what you have paid before plus what you are paying this year, and I drag that downwards, and that gets me what you will have ended up paying by the last year. So you'll notice one thing: using this fixed principal approach, you will actually end up paying less than someone who was giving the loan at a constant payment rate. So sometimes it might be that will work in your advantage if you're actually not planning to default. The only problem is it makes the loan a lot more heavy for you to bear at the beginning, and then so that's why some people might prefer the constant payment, and then most microfinance banks use the constant payment, and then some banks they use this one, maybe for salary loans, and they don't know if you will be in job next month or not. So that is for that. I'm going to move on to the next one, but before moving on, I want to check if you've dropped any question for me. Okay, so moving on, no questions. Any questions? Just again, don't forget to use the chat box. So moving on, what about you taking a car loan, or you want to buy a house, and they are allowed to do some flexible payment? So here's the scenario I'm going to walk us through. So you bought a 3-bedroom flat for 100 million naira, but then they said you should make 25% down payment, while you can spread the remainder of the money, into a monthly kind of repayment plan. So you're going to repay the remaining money after the 25% down payment, in a monthly repayment plan at a 2% rate, 2% monthly rate. So this is it. This is the value of the house. You bought a 100 million naira house. You have to make a down payment of 25 million naira. This is the remainder amount. So this remainder 75 million, they say they're going to let you repay flexibly at a 2% monthly rate. So let's say you want to spread the payment over 5 years, which is 60 months, right? How much will you need to be paying back monthly? So let's calculate that one. You want to pay back over the next 5 years, right? So how do you calculate how much you will need to pay every month for the next 5 years, to finish paying for the house, right? So again, we're back to PMT. That's why I say PMT is that formula you should get very, very familiar with. We used it in here to calculate savings goal, and now we are using it in here to calculate a loan repayment. You want to pay back a loan, you want to know how much you will need to be paying back every month. If the rate is 2% monthly, and you have to pay 75 million naira over 5 years, 60 different months. So let's see how it works. Again, equal to PMT. I open the brackets and insert function. This comes up. So again, what is the rate at which I am allowed to make the monthly repayment? So the rate is monthly rate of 2%. So this is a monthly rate. I don't need to divide by 12. And then number of periods. So number of periods, I have already broken the periods into months, right? So I'd converted the 5 years to months, which is 60 months. So I'm picking that. What is the money that you have to repay back, right? You have to pay back 75 million naira. You've already made 25 million down payment. This is the one that they are saying you should do a flexible payment over, right? So again, I put a minus before it. You have to pay back everything. You pay back at the end of the month, so nothing in here. So you understand all of this, why I'm leaving them blank. And then I'm going to do okay. So that says that I'm going to pay back 2 million naira every, like 2.14 million, 145 million naira every month. But then that is not my total payment. So I'm going to be paying this every month for the next 60 months, right? So next 60 months, right? But then I have to also now add them up to the down payment I have made. So the down payment I have made is 25 million naira. So that monthly payment times 60 months plus the down payment I have already made gives me the actual money I am paying. So my total payment is going to be 154 million 400 and like 154.5 million naira. So depends on you anyway, to pay that kind of amount for a 100 million naira house. You're kind of like paying, almost like uh, an extra half of the value on top. But then again, that is how interest rate kind of works, right? So it's like a loan, so you end up paying more than the actual value, the actual uh, list value, which is LIST, the cover price of the house, 100 million. So but that's how you know the calculation anyway. So instead of you just looking at it as, okay, I can afford 2 million naira per month, this actually shows you at the end of the period what you will have paid back, and then you will know maybe that house isn't that worth it, or maybe there are other options you should check out. So this makes you a lot more better at handling your finances, your personal finance, house plan, and the rest. So next is, how about a car loan? I really have things against car loans, but then there are some people who they really must take a car loan. So then how do you calculate, do some calculations around your car loan? So here's the situation we have in here. Your company has a car loan scheme. So you took a 4 million naira loan to buy a car using that your company's car loan scheme. But then now you will have to repay monthly, so there will be some monthly deductions from your salary. So there will be a monthly deduction from your salary. Someone is asking, can I review the last question? That is the compounded annualized rate, right? Compounded annualized rates. So if you're asking still about the compounded annualized rate, I said that if there is time, after if there's time after the whole if there's time after the whole after the webinar, the outline I have listed, then if there's time after the webinar, I'll go to it. The reason is, when it comes to compounding, there's a lot of assumptions. There are more data you need. There are many assumptions involved. Is it compounded monthly? Is it compounded daily? So that's why I don't want to detract us with it. So there are many assumptions involved. So okay, I've answered that question. Alright, so going back to this one, how long will it take to pay off the car loan if you make a monthly payment of 200,000 naira? So this is the car loan, 4 million naira, a monthly repayment rate of 2%, and then you want to be paying off the loan with 200,000 naira every month. So how long will it take you to repay the loan? So let's do the calculation. You want to be paying down 200,000 naira every month from your salary. How long will it take you to pay off the car loan? And that formula in Excel is NPAR, number of periods. So NPAR, I'm going to click on FX to bring up this, as usual, interactive formula dialog box. And then the rate. So what's the rate you're giving at? So 2%. How much are you paying every month? You're paying 200,000 naira from your salary every month. And then what is the loan you took, right? So the car loan is 4 million. So remember, I put minus there. You're going to pay back everything, so no future value, and then you pay back at the end of the month. So they deduct at the end of the month from your salary, so it's at the end of the period. So again, I leave that blank, and then okay, and then you can see it comes to 26 months, right? And sometimes this thing can give you decimal part. So let's check out if this thing actually gives us decimal part. Yeah, it gives us decimal part, but then there is no 0.796 months. So it's just best to round it up to and say, okay, you end up paying back over 26 months. So that means the last month they will deduct exactly the outstanding, what's left. So they won't deduct 200,000. All right, so but that's how you get to calculate how long it will take you to repay a loan. And then you can decide, what if you want to pay back, what if you want to pay back in exactly 2 years? 2 years is 24 months, right? How can you now answer that? That brings us to that our friendly formula, well, not a formula, a friendly tool that I did, I think 2 months ago, or is it last month? In one of the webinars we did either last month or 2 months ago, what if analysis. So let's do it together. So what if I want to set this to 24? How much do I need to pay back? So how much do I need to pay here to get 24 months? And remember, what if analysis under data menu, what if analysis, goal seek. I want to set a goal. So I want to set this goal to 24, right? And I want to change my repayment amount. So, and then I see, so change my repayment amount. Then I click on OK, and it does it, and it says if I want to pay back in 2 years exactly, then I have to tell them to deduct 211,484 naira from my you can see how accurate it is anyway. So you just tell them to deduct exactly this amount from your salary every month. So that is it. And going on, any question? So okay, I hope you are all following along. So moving on, what about you have a monthly investment goal? So you want to invest 40,000 naira every month in a 15% interest rate account, investment account. So in 10 years, how much will you have saved? In 30 years, how much would you have saved, right? So let's start with that calculation. In this case, the formula you will be using is FV, future value. Can I go back to goal seek? Okay, this is a tricky one. Okay, so it doesn't look like I'm not answering all of your questions, because you also asked me about the compound annualized rate. Okay, I'll do it so it doesn't look like maybe you've offended me somewhere and I'm holding it against you, and everything you ask I'm saying no, because I never planned. I've done that goal seeking in a previous webinar. So let me just do that again. So you're saying, can I redo the goal seek one? So the goal seek one was this, right? So I want to redo the goal seek one. Data menu, what if analysis, goal seek. So what do I want to set? I want to set this duration to 24. I want to repay in exactly 24 months, right? And then by changing what? I want to change the money I'm paying back every month. So I want to tell them, okay, deduct this amount from money from my salary, so I can end up paying the whole amount in exactly 2 years, 24 months. So that's why I say changing sale value is this, right? So that is it. Then do OK, and you see Excel does some iteration and comes to the final figure. And so it says you should tell them to deduct like 211,500 naira from your account. Okay, so that is it. And moving on now to this one. So again, what I have said is if you save 40,000 naira every month, and then at the interest rate of 15%, and then a duration of 10 years or 30 years, how much will you have saved? Now, you can't just straight away come here and start multiplying 40,000 naira times 12 months in a year, then times 12 years, and then that gives you 4.8 million. No, that would be wrong, because there is an interest rate involved. So the money you saved is actually growing. You cannot use this simplified calculation. So you have to use FV. So FV. So let's see how it works. So using FV, and so that is equal to FV, and then the rate. Okay, just give me 5 seconds. Let me close this window there. Okay, sorry for that. So continuing, the rate. At what rate were you giving the? At what rate is the investment growing? So it's growing at 15% rate, and then so what's the number of periods? So number of periods is you're saving for 10 years, and then so how much do you put in the? How much are you putting in every year? You're putting in 40,000 naira. No, this is not. Let's see, monthly. So it's monthly calculation. Let me redo that because it's monthly calculation. So equal to FV, and then this interactive formula box, right? So the rate is annual rate. So I'm going to say the rate divided by 12. Number of periods, because the money we are contributing is a monthly money, right? So number of periods is going to be this, and then times 12, because we have 12 months in a year, right? And so how much are you now paying? You're paying 40,000 naira monthly. And if you, because I know I'm going to get that minus issue again, so I put the minus before clicking on the 40,000 naira, and so I do okay, and you see what it comes to. So it's saying you will get 11 million naira, which is against, if you had done the verbatim, 40,000 times 10 years times 12 months in a year. See the huge difference, right? That's the power of interest rate. So that's why I say you will not be using these simplified calculations in a real life scenario, because interest rate affects the entire calculation, right? So let's now talk about what if it was 30 years. So let's do for 30 years. So the same situation, but now after 30 years, what will the money have amounted to, right? So 15% interest rate, which is annual, I divide it by 12 to get the monthly rate, and then I'm saving for 30 years. So 30 times 12, because we have 12 months in a year, and then once again I'm saving 40,000 every month, right? So that is it, and then I do okay, and see the huge difference. Just 20 years difference, but then this is almost like times 20. This is like 20-fold difference. So it's not just like this is, you left this for 10 years, you left it for 30 years, so this is like times 3 of this duration, right? But the effect is not times 3 of this. The effect is like times 25 of this. That again is the power of compound interest. So when interest rate is involved, and in real life all these things are compounded interest, then the whole calculation is no longer your normal arithmetic. It's kind of exponential, geometric kind of calculation. So that's why I say you'll be needing to get familiar with these Excel formulas for your own investment planning, and in this case monthly savings goal. So the last one, okay, so this is the last one before I show us the tools that we have to get familiar with for stocks analysis. So moving on to discounting and investment return. So this is a lot more useful for those who are into businesses. So you're trying to do some business planning. So let's see the questions I have. The scenario I have in here. So you are part of board of directors for a manufacturing company. The company is considering a business idea that will cost 300 million naira, but the business will generate 500 million naira in the 9th year. So after 9 years, the 300 million naira you guys are going to put into that business will bring you 500 million naira, right? So here's the question. If the company's cost of capital is 15%, maybe you borrowed money, you borrowed the 300 million naira from a bank at 15%, or as an investor you expect a 15% return on investment on your whatsoever money you've put into the business. So that's why we call it cost of capital for the company. It could be loan, it could be what the owners of the business are demanding as a return on investment. So now the question is, what will be the present value of this investment, and then is it a profitable one? Should you go ahead and execute the project? Is this investment going to be worth the 300? Is it going to be profitable? That's just the question. Assuming you borrowed that 300 million naira from a bank at 15%, will this thing make enough money for you to cover both the money you borrowed and the interest you will pay back on the loan? So that's a simplified way of explaining it. So let's now do the calculation. So to do this one, right, you use what we call a discount formula. It's a variant of the compound interest formula, right? So where they say, okay, I'll do it in here, you'll see how it works. So let's do it together. This is the initial amount, this is the future value. It's going to turn to 500 million. No, this is 500 million in here. It's going to turn to 500 million. Okay, so that should have been 500 million. And then the discount rate, the cost of the capital, so whether it's borrowed money or what you demand as return on investment. So then the duration, so this is going to be over a 9-year period. All right, so at this rate, is this business going to be profitable or not? So let's do it together. To know that, you have to discount the money, back to the present value, back to now. Discount it using the discount rate and see, is it at least equal to your original amount? So are you going to break even, or is it more? That means, are you going to make profit? If it is less, then you're going to make a loss. So it's better not to go into that business venture, right? So the formula is equal to, okay, it's equal to the future value, right, times, right, 1 divided by I'm using the very simplified way of writing it anyway. So 1 divided by 1 plus the discount rate raised to power the period in the future, in this case 9 years in the future. And so I'm going to now again close off this bracket and then close off this bracket. So this thing you are looking at here is a variant of compound interest kind of stuff, right? So this is what we use for discounting. So it's a discounting formula. If you do financial modeling, then you will need to be very familiar with this one. So I'm going to go ahead and just do enter. I'm going to share this Excel file so that you can be able to practice on your own self, by your own self, and follow along and review the formulas. So once I do that, you can see what it comes to, which is a lot less than the value is a lot less than what it is you have borrowed, right? So you shouldn't go into the business because you put in 300 million naira, and then the whole business is not giving you back what you put into it. So you will not want to go into the business, right? So put in 300 million naira, you get 500 million naira after 9 years, and you're using a 15% discount rate, and then you see that it's not worth it. So moving on, what if we change the whole situation? So let's say this business is not just going to give you 500 million at after 9 years. It's going to be giving you an annual cash flow. So this business is going to be giving you 50 million naira every year. So how are you going to now calculate whether it's worth it or not? So it's going to be the same scenario, but now it will be generating 50 million naira every year. So in this case, it's a little different, right? So let's calculate how it will work. So for this one, actually you will have to use the formula called PV. So you use a formula called PV, and let's see how it works. So you initial capital outlay 300 million naira, yearly inflow, it will be generating for you 70 million naira cash flow, and then again discount rate of 15%, duration of 9 years. So equal to PV, and then I use FX, and then what is the rate we are going to discount to it? This is the rate, 15%. What's the number of periods, over 9 years? And then how much is it giving us every year? So every year it's giving us, so if you remember I put a minus there, 70 million naira. So in this case, there's no left, there's no FV, there's no type. So I'm just going to straight away I'm just going to straight ahead go with OK, and you see the answer. And so it's telling us that at the end of the whole 9 years, this is the value of money you will have gotten back from the business. And actually this is more than your original cash outlay, right? Initial cash outflow. So it's going to be profitable, so you should go ahead with the business. Now you see how with these Excel formulas you can do most of all your personal finance planning and some of your business planning. So what are the formulas again? So the formulas that I've taken us through are PMT, IPMT, PPMT, PV, FV, rates, and HENPA. So these are financial formulas in Excel you should be familiar with. Then you should also learn how to do discounting. So also go and learn the discount rates formula, because that was what I used in this situation, right? So you should try Google it and be familiar with it. But then these are the ones that are already inbuilt into Excel that you will find very, very useful. So finally, in closing, but let me check if there are any questions. Okay, so no questions. Any questions? Okay, so continuing, the last bit is now, I said I was going to show us tools that I built, that I use. Some I built, yeah, actually these ones I'm showing you, I built them, and I use them for my own stock investment analysis, right? So it's like an add-in in Excel, Nigerian market data. So I'm going to show you how you can install it, but you need Excel 2016. So it's going to pull out, all the different companies listed on the Nigerian Stock Exchange, and then their stock price, so the closing price, their market capitalization. And so these are things you might find useful if you are into stocks investment, right? So I use this a lot, and it's free. And if you have a particular day, so let's say like now I'm interested in so maybe you have invested in, let's take, which stock can I take? So let's take Dangote Cement. Okay, so today now, so this is today's stock price, not today, yesterday. What if I wanted to see for a particular date? So I wanted to see for this same date last year. So this same date last year, I want to check out which companies have gone up, which ones are declined. So this same date last year, I type in the date and I say highlighted date, and it's going to go and pull out the stocks for that particular date. So you see it's gone in there and pulled out the stocks for that particular date. I don't know why it's wrapping. Okay, so you see, and now I can compare which which company went up, which one went down, and like that, right? So these are things that you might find useful, if you want to. Like now, I'm invested in Dangote Cement. So Dangote Cement, Dangote Cement. So has it gone up in price? As it's reduced? So it's currently 313 naira, but last year it was 182. So I can calculate how much it has grown. So I can calculate my return on investment, right? So I can calculate that one easily. So divided by this minus 1, and then so it has had a 17% or 16.93% growth rate. Then like that, so you can check out any company that you invest in and be able to monitor your investment. So that's that one. And also you can pull out the FX rate. So what is the rate of, it works with the CBN one anyway. And so see now, actually close to the parallel market. Now you can see this is 355.58 for USD. So as at last year, the naira was trading at 358 to the dollar. So let's check out, what about 4 months ago? So 4 months ago it will be March. So 4 months ago, this same day, what was it trading at? So what was the exchange rate? So you see, I put the date, and then I pick I say highlighted date, and you see, so it was 300, and this was when we were still using the fake CBN one. So you get some of this data in here for free. Not You get everything for free for now, right? You can pull out GDP growth rate, inflation rate. So let's pull out inflation. Then you can see how inflation is actually going down. So that is good, right? You can check it out, and you can see when everything started going up. As at 2016, and has been going up, and then it went as high as 18.7, but now it's coming down again. So these are things that you find useful. So I have a lot of all those useful things in here. And how do you install it? It's very easy. You go to insert on your PC, on your Excel 2016, and then you will see Hardins anyway. So they've moved it from my own version. They've moved it to Hardins, but in yours you will find it in insert, and you will see store. So you will see something look like store, something like this, but you'll find it in insert. So look for insert in yours. I'm using the latest version, like the preview version, the one that is not yet publicly available for everybody. So that's why I have mine here. So you click on store, but you'll find it in insert, remember. And then once you click on store, you're going to search for Nigerian market data. It's going to come up in a bit. This is taking too long. Well, while it's loading up, let me check if you have any question. Okay, so no question. So you come in here, you search for Nigerian market data, and do enter, and you see it, and then you can click on it, you add it, and that is it. There's even a video demonstration if you want. And so that is how you install it. And please, if you use it, be nice and do a rating, like rates. If you find it very useful, be nice to us, like a local developer here. Show some love to us. So anyway, that is that one. Then last part is, I also have a stock analysis dashboard that is also publicly available. So you can access it at let me put the website. You can access it at nigerianelite.com/shares/ so let me post it in here for us, so you can access it there, the stocks analysis dashboard, right? So I'm going to include it also as a comment in the video, right? And so once you go there, this is what you are going to get. Let me go there. So let me go there here now. So once you click on it, it's going to bring you to this. Okay, so it's going to come up in a bit. Any questions? We'll be rounding up in the next 3 minutes. So if you have any questions, I've already taken beyond the time schedule, so I don't think I'll be able to answer that compounded interest rate question. So it takes you in here and you can pick any company you want to analyze. So you want to check out how is Cadbury performing relative to Nestle. So I want to check out Cadbury versus Nestle. So maybe I pick Nestle. So I pick Nestle, and then I'm going to hold down the control key and pick Cadbury, and then I'm going to compare their performance. And so yeah, so that is it. Nestle has really been going up. Actually, Nestle is doing way better than Cadbury, income wise, return on assets. Let's check out return on assets. Same thing. So I'll probably buy Nestle, over Cadbury if you're just looking at this. But then there are other things you want to put in place, put into perspective. So let's do maybe Total versus Mobile. So Total versus Mobile. So Mobile, yeah. So I want to do the comparison. Let's check out how they are doing. So Mobile is the blue, Total is yellow, and you can see there's a big rivalry, and they're kind of going up and down in sync. So at a point, Mobile really got as high as let's see, Mobile was as high as 400 and something in 2008, while Total was not even that high, and then all of a sudden everything went down. Zoom. This was that 2008-9 crash, and then you see they've been going up kind of in sync. Then suddenly Mobile went up again. That was when Nipco acquired Mobile, and then it went up, and now it's come down again, really down. So you can see the whole story in the graph, right? So you can see it goes as far back as 2002, right? So this is really interesting, right? And the you can also see their return on assets. So return on assets, actually Mobile has been having better return on assets. Let's check out net income. So net income, most of the time Total has more income, and now the gap is a lot wide. So like that, right? These are things that you can do with this. So we have come to the end of the webinar. Thank you, and do check out these applications. I'm going to check if you have any question once again, and then I'm signing off. Okay, so you searched. It says no harding matching this criteria. You searched. Let me check. So let me search again. So you searched the store. What version of Excel are you using? Because it's only for Excel 2016. So what version of Excel are you using? It's only available in Excel 2016. You searched. Two people saying they searched and got the same thing. Okay, so let's go to financial. How about you just don't search, just look for financial management. So under the category, click on financial management, and then if you scroll down, you will find my tool as part of the listing. So you can see it's even like number 5, or should I say 4, under financial management. So you can try it out. Not Nigerian stock market, Nigerian market data. Nigeria market data. So that's the name. So search for Nigerian market data and you'll see it come up. It's Nigerian market data because it's more than just stock. It's, as you can see in here, it has forex, FX rates, crude oil, our crude oil production. If I wanted to pull out the daily crude oil, the monthly, if I want to pull out crude oil price, so crude oil is now $56 per barrel. What was it at the start of the year, or what was it 4 months ago? What was it in May or in April? So if I wanted to find out what it was in April, see crude oil, Brent, crude oil, and you see it was in April. Let's see, why is it bringing me two results? So it was 50. Which one will I pick? I have to figure out why it's bringing two results. But you see, it can also get you far back. You can go back in history and it will get you what the figures were. So thank you once again, and this is where I sign off. I've already used beyond the time allocated. So Chijioke, what version of Excel are you using? You must be using 2016. If you are not using 2016, you won't find it. So that's I'm thinking maybe that's why you still not found it. So thank you very much. If you have any suggestions of what you want us to do next, you know, what topic you would like to see us talk about next month, please do share, right? So thank you and have a nice rest of the day. And I'm signing off here. So I'm ending the webinar right here.